CVP is a powerful tool for break even analysis. For example, how much do you need to sell to make a profit? For estimating burn rates. For example, how much net cash is used each month for startups? Calculating profit at various sales volumes, in other words, sensitivity and scenario analysis. CVP helps clarify a company's financial business model. It's been very useful when I've worked with clients. Most businesses could be summarized as variable revenue minus variable expenses minus fixed expenses equals profit before taxes. This is called the cost volume profit or CVP analysis. It can be further broken down into this formula: the number of units sold times price minus the number of units sold times expense minus fixed costs equals profit. This CVP formula is based on accrual profit, so it multiplies the variable expense per unit by units sold. Accrual accounting tries to match expenses to related revenues. It's a useful and worthy exercise, but confuses non accounting people. You pay your bills with cash, not profit. Many small businesses budget only on a cash basis. If you want to run a CVP on a cash basis, use units produced instead of units sold when calculating variable costs. This image shows a cost volume profit graph. Fixed costs are $10,000. Each unit brings in $500 of revenue and costs $100, so each unit contributes $400 towards offsetting the fixed costs. At 25 units, the contribution from selling units equals fixed costs, so profit equals zero. This is the break even point. You may be tempted to think that CVP formula is the same as a simplified income statement, which is sales minus cost of goods minus other expenses equals profit before taxes, but it's not. The income statement is grouped by production costs and non production costs. CVP analysis groups costs by whether they vary with production or don't. Production overhead is applied to the cost of goods in the income statement but goes into fixed expenses for CVP analysis. Advertising expenses, especially search engine advertising, may be an expense that varies with revenue, go into other expenses in an income statement. The most important categorization of expenses for modeling is variable, step fixed, or fixed. For many financial reports, it's direct, indirect, or overhead.